Hey everyone, the EV industry had a challenging year in 2023. Macroeconomic factors including rising interest rates, slowing economic growth, and price competition led all EV companies to have a challenging year. But is 2024 going to be more of the same? Well, I'll look at some of the long run macroeconomic factors for the EV industry while I make the comparison on which one is the better EV stock to buy for 2024. Is it Nio or is it Lucid Group? I'll compare these two on their vital financial metrics, including valuation, to come up with that answer. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
I mentioned I would talk a little more about the EV market. Let's take a look at the total addressable market opportunity. Total spending on electric vehicles reached $539 billion in 2022. That figure is estimated to reach $907 billion worldwide in 2028. Industry-wide, this spending is supported by trillions in government incentives to support the transition to cleaner energy consumption. Additionally, governments worldwide, to varying degrees, are mandating manufacturers to produce a larger percentage of electric vehicles. Importantly, investors should be aware that without these government incentives, the growth of the EV industry would not be nearly as robust. After all, governments have been known to change their mind, to extend deadlines, and remove mandates altogether. Still, within this backdrop of incentives in play, the companies that are likely to benefit from the expected growth are Tesla, Rivian, Nio, and Lucid Motors. It remains to be seen if legacy automakers like Ford, General Motors, and Stellantis will ultimately benefit from this transition. That being said, we can look at the revenue growth for these two companies, and we can see they're only in a fraction of the market size, with Nio generating 7.7 billion in trailing 12-month revenue, while Lucid Group is much smaller at 695 million in trailing 12-month revenue. Nio has done a solid job increasing revenue over the last couple of years, while Lucid is only starting out, and 2023 was a difficult year that saw the company decrease their forecast for vehicle production a couple of times. However, I'm going to show you in a little while their longer term, well, not longer term, but 2-year forecast for revenue, and those expectations look phenomenal for Lucid. Interestingly, while they're significantly different in terms of revenue, they're similar in terms of net losses on the bottom line. You could see Nio and Lucid Group moving pretty much very closely and very near each other in their most recent quarter, with 630 and 639 million in net loss on the bottom line. However, this net loss looks much worse for Lucid because they're losing 630 million in profitability on the bottom line while they're only generating less than 1 billion in revenue. So that the proportion makes it look worse. But let's look at the 2-year forecast. I mentioned that Lucid has excellent forecasts for the next couple of years. You can see revenue growth is expected to be 118% in fiscal year 2024 for Lucid as it ramps up production, as it gets their new models into market. And then for 2025, it's expected to be even better with 172% revenue growth for Lucid. That's expected to improve their loss on the bottom line, with earnings per share or loss per share improving from $1.34 in 2023 to a loss of $1.06 in 2024 to a loss of 78 cents in 2025. So losses are expected to continue for a couple more years for Lucid at least. For Nio, the revenue growth expectation is for 40% in 2024 and for 40% again in 2025, with the loss per share improving from $10.35 to $5.89 to $2.16. So meaningful improvement in the loss per share. But again, Nio as well as Lucid is expected to lose money on the bottom line for at least a couple more years as it continues to ramp up and reach the scale, the size, where it can generate profitability on the bottom line. So now let's take a look at shareholder dilution, because if these companies are losing so much money, then where is the money coming from? It's coming from investors. So that means they're diluting shareholders. Nio has increased its shares outstanding from around 1.4 billion to 1.7 billion. Lucid Group, meanwhile, after its initial public offering, had 1.6 billion shares, and that's increased to 2.28 billion. And each of these two, I suspect, will continue to dilute shareholders over the next couple of years because they're going to be losing a lot of money on the bottom line, and they're going to need to go back to investors and ask for more money. Because when we look at their balance sheet here, Lucid has $4.4 billion in cash and $2 billion in long-term debt, while Nio has $5.3 billion in cash and $3 billion in long-term debt. At the pace of their losses at $639 million every quarter, you can see that these $4 billion and $5 billion is not going to last very long at that rate unless they improve and reduce those losses on the bottom line, which analysts expect them to improve those losses on the bottom line. As they ramp up production, as they make more sales, that's going to reduce the loss on the bottom line because each incremental car, at least for Nio, each incremental car generates contribution profit. Lucid, meanwhile, not yet, but it is reducing losses by selling incremental cars and ramping up production so that it can utilize the manufacturing facility it has already built. And finally, I wanted to look at valuation. Lucid is trading at a forward price to sales of 7.072 compared to Nio with the forward price to sales of 1.292. Now you can understand why Lucid is nearly 6 times more expensive than Nio, and that was mostly due to its excellent growth prospects over 2024 and 2025. 118% revenue growth and 172% revenue growth expected for the next 2 years. And remember, we said Nio is expected to grow at 40% over the next 2 years. So Lucid is expected to grow at about 3 times the rate of Nio, and it's a much smaller company, so the potential for growth is larger in the near term. However, that being said, if I had to pick between one of these two EV stocks to buy for 2024, I would pick Nio. I like that Nio has made more progress in expansion. I like that Nio is generating a positive vehicle margin, meaning a positive gross profit margin on each car that it sells, while Lucid is at least a couple of years away from generating that positive gross profit margin. So the Nio is selling at, a fraction of the valuation. So for those reasons, if I had to pick one, I would pick Nio to buy today. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.